Hello everyone, I'm Marty Pospisil and welcome to the February 2025 market update. I've been waiting for all the data to come in and I've finally gathered it all together, to put my presentation together. Thanks for joining me and let's jump right into it. Lots to chat about today. Firstly, I want to point out just a little bit more about my company, my mission statement, who we are. The goal for the company's kind of changed over the last few years, more from a revenue-based, more towards community-oriented education and community-oriented facilitation of helping and assisting people move from one property to another. So we're striving now to provide support to anyone transitioning in life, whether or not they have a realtor or not. And because that's a big part of their lives when they're actually switching from one property to another. It's a big decision, and it's our mission as members of the community to help them do that. So we've sort of become a little bit more community oriented than maybe we were 10 years ago, and that's transitioned over many years. And we're doing this through education, of course, offering the services for people who do want to make that move, and all the tools are at our disposal to help them through that. So we're doing educational seminars like my updates, first-time buyer seminars, downsizing seminars I'm doing a couple times a year. We also have our Knowledge Center on the PRG website, which has everything in there, all the taxes, all the programs, really good knowledge center on pospisilrealty.com. And of course, we do a lot of community events now as well. So just wanted to share that with you. And I invite you to come to our website, watch our videos, watch the podcasts, etc. A lot of good information we're putting out there. Very good. Now, jumping from that right into the highlights for this month, we got mainly the market has glided through January. We're getting really good activity, excuse me, on the listings we have now. But compared to last year, detached houses were pretty well the same in activity. The benchmark price slightly up for houses, 3.1% from this time last year, and pretty well the same as last month, slight increase. Attached townhomes and duplexes, an increase in activity of almost 13%, slight jump in price, almost 3%, and pretty well the same pricing as we had last month. Same with apartment condos. We're up in activity year over year. The benchmark price, just a 1.7% drop, and pretty well the same pricing as the previous month. So our January stats, of course, increased from February, but have kind of glided through for a number of reasons, which I'll talk about today. Let's break it up into product type and area first. As you know, I use the sales ratio or the absorption rate to track the activity in the market. And if we're below 11%, we're in a buyer's market. If we're 12 to 20, we're in a balanced market. And if we're over 21, it's a very heated seller's market. So those are the sort of different delineations I use to look at how active the market is. Let's look at detached houses. Firstly, for January, we had, of course, 10%. Just when I put all the data together for the end of the month, that's cooled off just slightly over the last month to 6%. And that puts us just in the buyer's market category. But again, there's not a lot of product for people to choose because the inventory hasn't built up yet. And that's a factor in that sales ratio. We're actually doing quite well in the listings that we are selling now. Condos and townhomes on the west side, we're at 20% last month. Right now we're at 13%. So we're in balanced market territory for attached product over the last month. And if we look at condos, townhomes downtown, pretty well the same thing. We're at 11%. That's just the top end of the buyer's market. So pretty consistent from where we started out the month at. If we go into the east side, you can see we're at 7%, and that's in buyer's market territory for houses on the east side. Attached condos, townhomes, east side, we are at 19%. That's the biggest and most active product right now for attached product. and that puts that in balanced market territory, just at the top end of the range. But you can also see that balanced market range for all of BC. There was that slight dip last year as it came down slightly, but we're at the very top of that balanced market range, and it's going to jump as soon as that consumer confidence starts to peak back into seller's market range. So what's happening with the prices? If we look at average pricing, we are hovering around that peak pricing for all product, for houses, for townhomes, and for condos. Not a lot of change, and it is fluctuating up there slightly depending on what's happening month to month, but pretty consistent. If we look at the 5-year housing price index trend, again, prices are high and relatively stable. So we're not seeing major change in pricing over the last few months. Forecasting, I got to take that last photo out of there. Let's look at the drivers that we're looking at now. Now, what's changed over the last month is our first one, the consumer confidence, which is very high going into the year, with a little bit of anticipation of what's going to happen with our neighbor's president to the south. What's he going to do? The whole talk of the tariffs thing, I'm going to do a little bit of a deep dive into that later on in my presentation, but that has impacted consumer confidence for some Canadians, because many Canadians, when there's anything like that going on, they tend to wait and see how it's going to pan out before they act. But that also creates great opportunity for our sellers and buyers now, and I will expand on that a little bit later on. So consumer confidence is transitioning. It's right between an enhancer or a deterrent. Inflation and the economy is good. At this point in time, inflation is actually below the 2 to 3% happiness band, I call it, for the Bank of Canada. And the economy, again, we'll talk about a little bit more coming up in my presentation. Cost of borrowing is improving. It was red last year, but the overnight lending rate has been coming down steadily, another 25 basis point drop recently, and that's going to continue, they say, through the year. So that's actually going to turn green pretty soon. I'm hoping within the next couple of months. That would be a great thing to have happen. And the inventory levels are low, but they are increasing, and that's going to provide more selection for the buyers and sellers. And when that momentum builds this month, we're going to see that activity increase and start to impact the consumer confidence as well. So a lot of things that we're watching. So as we had in a very active market, we've got the consumer jumping up and down, and there's a little bit of a worried anticipation out there with what's happening politically right now. But again, we've got a lot of buyers who are acting and a lot of sellers taking advantage of that. But we'll talk about that. Let's give you some good news as well as I'm going through this. The capital gains effective date is delayed. Now, the government officially announced that capital gains inclusion rate increase from 1/2 to 2/3 has been now delayed from June 25th last year to January 1st, 2026. So what does that mean? That means that half of your gains on an investment property are taxable at your marginal tax rate, and 50% is tax-free. That had changed earlier, and everybody was panicking to sell before June 25th of last year, but now that's been extended to January 1st, 2026. So that's great news for investors who are selling their homes. All of my investors who are selling this year are thrilled to hear that we're back to that 50% for this year, and a lot of them are taking advantage of that. So that being said, remember, October 20th is our next federal election, and if there's perhaps a change in our current government, don't forget to vote. This whole capital gains change might go out the window. Wouldn't that be great? And that will sort of spur our market on as well. So get out there and vote this fall before that January 1st, 2026 deadline. Unemployment. Canada, we're actually just popped up to 6.8%. BC is at 6% unemployment, so fairly consistent there. Retail sales are, of course, humming along nicely. The Canadian monthly GDP in real estate was up 3.4%, so that's good. Overall, the GDP for Canada increased 0.2% in December. It takes a little bit longer for that data to come in. And we're going to talk about the economy as we get into some other things related to the policies from the US and how that might impact our market. So before we jump into that, another consumer confidence item that I track, the rental rates. And you can see the overall rental rates dropped down 0.3% from last month to $3.09 a square foot to $3.08 consistently. Now they've sort of leveled off. That's good news. Rental rates aren't changing dramatically. Construction starts are, of course, way up. That hasn't changed. And the BC, another flipping tax I call it, the BC home flipping tax I talked about last month. But again, the highlights are it actually applies to primary residence and investment properties. So this BC flipping tax applies to everything, more or less. There are some exemptions, which we will expand on in my website on the Knowledge Center. But it's basically, if you buy a property and sell it within the first 2 years, you're going to pay tax. Okay? They're considering you flipping if you're selling a property within 2 years. It's a little bit draconian, but they figure they're going to catch all these flippers, which would be interesting to see the stats of how many people are investors that are doing this. But anyways, if it's within the first year, you will pay 20% of your lift from when you bought to when you sold. If it's within the second year, it decreases linearly to 0 when you hit that second year mark. So this only applies if you're selling a property that you bought within a 2-year period. Okay, and it applies to everyone, individuals, corporations, and there are some exemptions. So if you're unsure about this, pop me an email. I can look into it further for you and let you know if you might be exempt. Okay, perfect. There's the tax man chasing the investor. Inflation. Okay, good news. Inflation's down at 1.83%. We're about 1% lower than our friends to the south. That's good news. Got a little bit of play there. It was 1.9 last month, so it has dropped. Good job, Tiff. He's happy, smiling. The overnight rate just dropped down to 3%. So that is 6 consecutive drops that he's gone through. And that, of course, immediately benefits the variable rate mortgage holders. We're going to talk about the bond rates and fixed rates a little bit later. And borrowers are getting excited because that trend should continue. And there's some other external factors coming into that, which I'll talk about. But that's great. We've dropped now from 5% overnight lending rate to 3%. That's 200 basis points since last year. So over the last year. So that's great. And we're expecting those bank rate cuts to continue. That's the best news. So just watch out. Money's going to become cheaper and cheaper. Okay, there's a consumer house price index, or consumer price index, and we are certainly below that band, which is below between 2 and 3%. We're at 1.83, so we're looking great for inflation. And when we come to our relation with the inflation rate with our neighbors, that's good. We're about 1% below. They're at 2.89%. And you can see they've actually increased last month and we have dropped. So that's good news. And the overnight target rate here in Canada is 3%. And just down south, they're at 4.33%. So it's all good. We're pretty well in sync. Plus, we've got a 1% buffer. We might need that as things might get a little bit bumpy over the next couple of months, but we'll chat about that. Cost of borrowing. So again, as those overnight rates drop, the variable rates get cheaper. Fixed mortgages we're going to dive into a little more. Here's the big elephant in the room. Let's talk about that. Tariffs on Canadian imports to the US will definitely impact our GDP. And the estimate is a loss of 1 to 5.5% of real GDP. Significant impact if this whole thing happens. So the Trump effect, I'm calling it. If there's a 25% on all imports from Canada, we've got a month breather. Everybody's sat back and they're trying to figure this out. Hopefully it won't happen. There he is, good photo of him. Here's what's interesting. There is a silver lining. So let me explore that to give you a little bit of positive spin in this whole thing. How do U.S. tariffs impact the economy and inflation? Well, I think most of you know the answer. If the tariffs do come into play, it increases the prices of goods and the consumers and businesses, of course, pay. If the consumers or the businesses can find a less expensive alternative from another country to reduce the costs, then of course the costs become higher for our companies and the consumers. And what that means, we have lower exports, lower production of goods, and some layoffs resulting in a weaker Canadian dollar and a weaker economy. So yes, tariffs in all likelihood will impact our economy. Our GDP will go down in BC and in Canada and ultimately cause inflation. Okay, so that's my first point. We know that. Am I bluffing? We'll see. This is the first point I want to make. Now, we know that fixed rate mortgages are a function of the economy and bond yields. So how does the economy, now remember, tariffs will impact the economy negatively. How does the economy impact bond yields? Now, this is kind of a complicated area for many people, including myself, so I had to read up a little bit on this so I could figure it out. Bond yields are closely tied to the economic outlook, okay, and monetary policy decisions. Recent economic data in Canada indicates a weakening economy, including falling inflation, a slowdown in consumer spending, and weak employment data. Okay, we know that. A softening economy and a stable inflation rate around 2% will likely lead to more interest rate cuts and a favorable environment for declining bond yields. So in other words, bond yields will likely decline. And as interest rates drop, the yields you receive from bonds will also drop. So simply put, when the economy weakens, bond yields drop. Okay, that's the second relationship I want to point out. But how do bond yields impact fixed mortgage rates? Remember, we know variable are going to follow the overnight lending rate. That's a given. But fixed rates, 3-year, 5-year, 7-year, 10-year fixed rates are a factor of bond yields. So as bond yields serve as a benchmark for fixed mortgage rates, bond yields decrease, lenders' borrowing costs decrease. Does that make sense? Lenders' borrowing costs decrease, allowing them to offer lower fixed mortgage rates to borrowers. So in other words, and of course they match up. You got a 3-year bond, that will directly impact the 3-year fixed rate. 5-year bonds will impact the 5-year fixed rate. But in summary, simply put, bond yields drop. When bond yields drop, fixed mortgage rates drop. So that's the third point I want to make. There's a bit of a catch-all here that the Bank of Canada and the government and all of those other factors might be a little bit more cautious on the lowering of the bond yields as they decline. The mortgage rates may not align perfectly with the drop in bond yields because lenders and mortgage providers will likely maintain risk premiums in their pricing to mitigate potential economic changes. So they're going to be careful, but in general, as the bond yields drop, fixed mortgage rates drop. Okay, so let's put all this together. What does this mean? This means that if U.S. tariffs come into play, it'll weaken the Canadian economy and ultimately cause inflation. Okay, we've talked about that. When the economy weakens, bond yields drop. Okay, yeah, we talked about that. When the bonds yields drop, fixed mortgage rates will drop. Okay, you see where I'm going here. So it could negatively impact our economy, bringing bonds yields, in turn, interest rates down. So that's good news. So in other words, fixed rates could very likely drop with the introduction of tariffs. Wow, who would have thunk it? But if a trade war ensues between us and the US, the loonie would also fall. This could happen over time, and inflation would increase. And if inflation starts increasing dramatically, then of course the Bank of Canada might be forced to raise rates again. Well, if variable rates go up, that's just bad news. Here's my thought. If everything happens on a certain path, it's possible that our fixed rates might actually drop. There will be a window in there before inflation and the weakened loonie kicks in, and the rates could start to increase, the variable rates again. So, in other words, timing is everything, but there's an opportunity for you if you're renewing or you're getting a new mortgage, possibly, don't guarantee anything, but maybe go variable, open, follow it through, and when those fixed rates start to drop, when they hit bottom, they're not going to toll a bell. You got to be in tune with all of this with your banker and your accountant and anybody who's in the know. Lock it in for as long as you can at that lowest fixed rate. So there's an opportunity there, but timing is everything. There's Buck Branahan also saying timing is everything, but also Chris de Burgh also said timing was everything. So who actually came up with that phrase? First, where did that originate from? I actually researched it, and it was actually William Shakespeare in 1599 said timing is everything in his play Julius Caesar. So there you go, a bit of trivia for you. And also another tidbit I'll throw in for the whole play here is the costs of tariffs is assumed to fully pass through to the consumer prices over 3 years. It could be as quickly as 1 year in some product, but up to 3 years on average for it to hit the consumer. So that's quite a long time. So this whole process of rate changes and everything could take some time. But if you watch it, there could be a silver lining here, and I think many buyers are, because in the last several sales we had multiple offers in all these properties. So there's buyers out there taking advantage of this opportunity now. They're going variable or open variable, and they're watching what's happening because those fixed rates might actually fall. I hope I'm right. So the yield curve. You ever had someone say, well, we're watching the yield curve, and you know what that means for the economy? I, of course, had no idea what they're talking about. So I looked it up, and I'm going to explain it to you. Hopefully I'm right in what I'm saying here. Here's the yield curve. And all the yield curve is plots of bond interest rate yields with different bond maturity rates. So, for example, if you look at this blue curve, which is the normal yield curve, for the shorter term maturity of bonds, they have a lower rate, and for longer term maturity, that rate goes up. So that blue line is a normal yield curve. A normal yield curve shows an upward sweeping where short-term rates are lower. Companies and people are more likely to borrow money and buy, driving up the economy. So a normal yield curve is actually good for the economy. Okay, I understand that. A flat yield curve means short and long-term rates are the same. Okay. What about an inverted yield curve? You've heard that. We've got an inverted yield curve. We're going to go into a recession. I've heard accountants say that. They don't all talk like that, but and economists. But and they're all good people, really good, because without them we wouldn't know what the heck's going on. So, but an inverted yield curve is when short-term rates are higher than long-term rates. Now, the theory is that a short-term rate in bond rates are high, so companies and people won't borrow and spend, slowing the economy down. In some cases, it may predict an oncoming recession. So this inverted yield curve is a sign that things could turn badly. But here's one last point. This is my yield curve lesson. In the inverted yield curve, in four of the last 5 recessions, it was more than a year after the inverted yield curve before a recession began. Wow, that's kind of cool. So follow that yield curve, I guess, and then maybe within a year or so after that, we might fall into a recession. So that's kind of interesting stuff. I kind of understand it now a little bit better. I hope you found that informative. So The power for today's cats, just looking at the rates, if we're looking at a 5-year rate at 4.29, hasn't changed much yet. If I'm right about those other factors, we're going to see a drop in that. If we take all of that, it's costing about $542 per 100,000 borrowed, $5,420 if you're borrowing $1 million. That's your monthly payment. So if you're an investor or just buying something to live in, owner-occupier, that's a good number to follow at today's fixed 5-year rate. And the variable rate's about the same. There's not much difference between the two. In October, it's dropped slightly. Okay, so inventory levels. Not a lot new there, but they are starting to increase. Vancouver West Side houses, you can see we're up a bit last month. We're looking at attached West Side, big jump in product there, so a lot of listings coming online over the past month. And East Side inventory houses, slight increase and a big jump in attached. So we're seeing a lot of product in attached coming online over the last month, and a little product on detached coming on both in the west and the east side of Vancouver. So what's next for prices? Okay, so here was something I saw in the Globe and Mail. Experts predict 2025 will be the year that home prices pick up after 3 long years of a flat to down trend. So that's good news. I love that. Great shot. Must be back east. And oh, did you see one more thing in that slide? Local traffic only. There's a message. Foreign home buyers ban. So in conclusion, these are the things that I'm watching that will impact our real estate market. Number 1, mortgage rates. Number 2, inventory. And number 3, consumer demand. We know those are the things that are driving our market. Inflation is within the Bank of Canada happiness zone. It's actually below it. Bank of Canada has reached the perfect 3% overnight lending rate and is expected to continue drops. That's a happy face. So that's good news. Inventory is low and increasing. Great for my sellers. If they're putting a home in the market now, there's not a lot of competition. There's a lot of buyers out there who are pre-approved at these open rates that are locking in and buying investments and homes to live in now. So that's good news. The Trump and tariffs, well, that's kind of not the best news, but we'll see what happens there. Maybe we'll reach an agreement over the next month, kind of leaving us hanging there. So pent-up demand is releasing now. We're seeing those buyers out there. They're looking at product. We're busy showing our properties. Variable mortgage rates are continuing to drop as the overnight lending rate drops. Fixed mortgage rates, I predict, will drop temporarily for buyers to lock into. Watch it and lock in when it hits bottom, and you'll be happy. Well, you should be happy now. Looser mortgage rules, that got introduced. We can go 30-year amortizations. And of course, that delayed capital gains tax date and possible elimination, vote in October, don't forget, could eliminate that capital gains change. So in summary, the market is stable and good and is about to be great. Okay, we're just waiting for a couple of things to change in the weather, flowers to come out, and everybody to get along, and our market's just going to take off because there's so much demand just waiting to happen. So 2025 will be somewhat unpredictable because of the whole political instability, I guess we'll call it, is starting out strong. Like I said, every property we've sold this year, multiple offers, selling well above list. So that's good news. And the stage is set for a strong blast of activity. So that's good news. And again, a whole bunch of things can happen over the next month even, and hopefully they're positive. And even if they're not, there's a silver lining for everything, and I hope I got that point across. So BC home sale predictions across BC, you can see 2025 is predicted to have a big jump over 2024, and the same for 2026. So things are looking good, even though it's snowy and cold out now. Eventually that snow will melt and the sun's going to come out and you're going to be back on the beach and on the seawall and on the mountains. You might be in the mountains now skiing, and enjoying Vancouver as all of us love to do. So that is my market update. I hope you enjoyed it. You can see these videos on YouTube, Instagram, and Facebook. And we've also podcasted them on YouTube Music, Apple Podcasts, and Spotify. And remember, buy Canadian. No offense to our viewers and subscribers down south, but we didn't start this. So a lot of us are starting to buy Canadian product. Hopefully, this will all resolve and everybody moves on. Thank you very much for watching, and hopefully that snow will melt too, and that sun's going to come. It's actually coming out right now. Fantastic. Enjoy the rest of February. Sorry it was a couple days getting the last stats in. I hope you enjoyed my presentation, and I wish you guys all the best for the rest of February. Let's touch base again in early March.